Welcome back, everyone, to the deep dive. This time, we're taking a deep dive into Edward Chancellor's book, Devil Take the Hindmost, A History of Financial Speculation.
Oh, fantastic choice.
It's a fascinating look at, speculative bubbles and manias throughout history, from, like, ancient Rome all the way to the dot-com bubble and beyond.
Yeah, I mean, it really shows how these patterns just keep repeating themselves.
Yeah, and what's so interesting is that it's not just about the financial markets themselves, but it's also about like human psychology and the social and cultural forces that, contribute to these bubbles.
Absolutely. So where are we jumping in? What's first?
Well, I think we should start with how Chancellor actually defines speculation.
Okay, good place to start.
Yeah.
Lay the groundwork.
Yeah, because like it's one of those things that everyone kind of throws around, but it's not always clear what it actually means, right? He's got this great quote in the book where he says, clarifying the difference between investment and speculation is like explaining to a troubled adolescent that love and passion are two different things.
Ooh, that's a good one. Very Chancellor.
Right. So how do you, as an expert, how do you kind of interpret that?
I think he's getting at the idea that, there, it is this kind of fundamental difference between like investing for the long term and trying to make a quick buck.
Right, right.
But in practice, it's not always so easy to tell them apart.
Yeah, yeah. It's definitely a blurry line.
Yeah. Like, think about it this way. Is buying a hot stock that everyone's talking about investing or speculation?
All right, it depends.
It totally depends, right? It depends on your time horizon, your risk tolerance, like all sorts of factors.
Exactly.
But I think the key thing is that speculation tends to be driven more by, emotions like greed and fear.
Yeah, that fear of missing out.
That FOMO, right. Whereas investing is, ideally more about rational analysis and long-term value creation.
Right. And Chancellor points out that speculation is not a new thing, right? Like it's not just a product of the modern world.
Not at all. He goes all the way back to ancient Rome.
Really?
Yeah. People were speculating on things like property and commodities, even currency crises.
Wow, that's incredible. So this has been going on for centuries.
Yeah, it seems like it's kind of hardwired into human nature, this desire to get rich quick.
I guess so. And speaking of like classic examples of speculation, we have to talk about the Dutch tulip mania.
Oh, yeah, the granddaddy of the hall.
This is like 17th century Holland, right? Where people were like going crazy for tulips.
Absolutely. I mean, you had people mortgaging their homes,
Yeah.
spending their life savings all to get their hands on these, bulbs.
Yeah, and the book has these amazing anecdotes about like how much these tulips were actually selling for.
It's mind-boggling. Some of them were going for more than like a house in Amsterdam.
More than a house. I mean, how does that even happen?
It's a combination of things. The tulips themselves were new and exotic, kind of like, a hot new technology today.
Right.
And then you had this system called wind handle, which was basically like futures trading for tulips.
So people were buying tulips that like didn't even exist yet.
Exactly. And that created this huge amount of leverage where people could amplify their bets.
Which is, of course, dangerous when things go south.
Oh, yeah. And they did go south. Big time.
So when the bubble burst, what happened?
Well, let's just say a lot of people lost a lot of money. And the Dutch economy took a major hit.
Right. And it's interesting because Chancellor points out that, even though it was tulips back then, it's not that different from some of the bubbles we've seen in recent times.
Right. You see the same patterns with, new technologies, leverage, and that kind of herd mentality where everyone's just afraid of missing out.
Yeah, it's like that fear of missing out just takes over.
And that's what drives prices way beyond any rational valuation.
So it's not just about the asset itself, it's also about what owning it says about you.
Exactly. It's
Right.
about status. It's about being part of the in crowd.
Okay, so we've talked about tulips. What's next on our historical tour of bubbles?
Well, let's hop over to 18th century England
Okay.
and take a look at the South Sea bubble.
Oh, the South Sea Company. Yeah, this one felt so relevant to today's world.
Oh, absolutely.
You've got this company managing government debt, rumors of insider trading, and this market that's just driven by like greed and hype.
It's like reading a financial news headline from like yesterday.
Right. It's crazy how much it mirrors what we see today.
Yeah, what's fascinating is how Chancellor connects the South Sea Company to modern corporations that get caught up in these speculative frenzies.
Yeah, like he talks about how they use their stock for acquisitions and the promises of massive returns.
Yeah, it's like a pattern that keeps repeating itself.
And what's also interesting is that it wasn't just like a few wealthy investors who got caught up in this.
No, not at all. Chancellor points out how speculation in the South Sea Company spread through every level of society.
Right, it was like this national obsession.
Yeah, and when you see everyone around you seemingly getting rich, it's easy to get swept up in that in the crowd.
Yeah, even if it means making like irrational decisions.
Exactly. FOMO is a powerful force.
So this bubble eventually bursts, right?
Oh, yeah.
Like all bubbles do. And what's the fallout like?
Well, it's not pretty. The British economy takes a huge hit, and there's this lingering sense of distrust and disillusionment.
Right. It's like a national hangover.
Yeah, and the book even draws parallels to modern financial crises. We see similar things with leverage, magnifying losses, calls for government bailouts.
Right. And that long-term damage to investor confidence.
Yeah.
It's a good reminder that, even though the players in the game change, the underlying dynamics of speculation remain eerily consistent.
Yeah. Human nature is a constant.
So what happens next in our whirlwind tour of financial history? Where do we go from here?
Well, next we're heading to the Roaring '20s and the 1929 crash. Buckle up.
Ooh, okay. That's a big one.
Yeah. Get ready for a dose of this time it's different thinking.
Oh boy, here I go again.
Yep. Fueled by the belief that America had entered a new era of unending prosperity. But we know how that story ends.
So this new era belief, everyone's buying into it, but what actually causes the 1929 crash? Like what pushes it over the edge?
Well, the book points to, margin buying is a big culprit.
Margin buying.
Yeah. People were essentially buying stocks with borrowed money, so it's amplifying both their gains and their losses.
Yeah.
And easy credit.
Yeah.
You know.
Oh, that makes sense.
Yeah, it fuels a bubble.
Because everyone thinks.
Because people underestimate the risk when they think they can easily repay their debts.
Right. It's like that saying, if you owe the bank $1,000, that's your problem. If you owe the bank $1 million, that's the bank's problem.
Exactly.
But then in 1929, it was just like everyone's problem became everyone's problem.
Yeah, and the fallout was devastating.
Yeah.
Right.
Uh-huh.
The U.S. economy plunged into the Great Depression, which had ripple effects across the world.
Yeah.
It's just a stark reminder that markets aren't always rational, bubbles do burst, and the fallout can be brutal.
Makes you wonder if we've learned anything, I mean, we still see those similar warning signs today. Inflated asset prices, readily available credit.
Oh, yeah.
The persistent belief that this time it's different. Are we setting ourselves up for another major crash? What do you think?
I mean, that is the million-dollar question, right?
Yeah.
And the book explores, how these cycles of boom and bust, they just seem to be ingrained in our financial systems.
Right.
It's like we can't resist the allure of easy money and the thrill of the gamble.
Yeah.
Even when history tells us it's likely to end badly.
Yeah. So where do we go from there? After 1929, the crash, does the world just swear off speculation forever?
Not quite.
Okay.
Chancellor actually takes us on a detour into the rise of the rogue economist. I think this is where the narrative gets really interesting.
Okay, the rogue economist, what is that?
So the book examines how free market economic theories started to change people's perceptions of speculation.
Oh, interesting.
Yeah, so instead of it being seen as like a villain, right?
Yeah.
Speculation is now being framed as, well,
A hero.
kind of, yeah, in a way.
Okay.
Figures like Milton Friedman, right? They challenged that traditional view that speculation is harmful, and they argued that it actually plays a vital role in making markets more efficient.
Yeah. Okay, so a little speculation's a good thing.
Essentially, yeah, they argued that it's just a natural part of a healthy market.
Okay.
Of course, the book presents a more nuanced view, pointing out that while speculation can be beneficial, it also needs to be carefully managed to prevent excesses.
Right, because unrestrained speculation is what gets you those bubbles and crashes.
Precisely.
Right.
And one of the most vivid examples of that is actually Japan's bubble economy of the 1980s.
Oh.
This is where the book really dives into how a culture of speculation, fueled by easy money and government policies, can lead to a total economic meltdown.
So this isn't just like individual greed. This is like a systemic...
This was a systemic issue.
Yeah.
The whole country caught up in this speculative frenzy.
Got it. And so what's so fascinating about the Japanese case?
Well, it wasn't just, a few rogue traders or anything. It was like deeply embedded in their system.
Right.
Right? They had this period of, rapid economic growth, a strong yen, And there was this belief that,
That they were invincible.
yeah, that Japan was invincible.
Right, so everyone's feeling good, and then that kind of spills over into the markets. What happens next?
Well, people start looking for ways to get rich quick,
Right.
right? And they turn to real estate and the stock market.
Makes sense.
Yeah, and the government also plays a role. They have these easy money policies, low interest rates, which create a lot of liquidity, which further inflated the bubble.
Oh, so they're just kind of like pouring gasoline on the fire.
Yeah, pretty much.
Sounds like a recipe for disaster.
To say-
Were there any warning signs, like, along the way that things were getting out of control?
Oh, there were plenty.
Okay.
The price-to-earnings ratios on Japanese stocks,
Yeah.
they reached absurd levels,
Wow.
but investors just seemed to ignore them.
They just didn't care.
Nope. The book describes it as like a classic case of irrational exuberance.
Oh, yeah.
Like they just thought it would go on forever.
Okay, so the bubble bursts. What happens?
Well, the Japanese stock market crashes in 1990,
Okay.
and the economy enters this like prolonged period of stagnation.
Right.
Banks are left with mountains of bad loans, companies go bankrupt, millions of people lose their jobs and their savings.
It's like that slow motion train wreck that you were talking about earlier.
Yeah.
And what's even more tragic is that, even decades later,
Yeah.
Japan is still struggling to fully recover from those excesses.
It's a sobering reminder
Yeah.
that speculative bubbles, while they may seem exciting at the time,
Yeah,
can have long-lasting consequences.
for sure. So
Yeah.
I guess that kind of brings us to the present day. We've seen these patterns play out again and again throughout history.
Yeah.
So what have we learned? I mean, what are the key takeaways from Chancellor's book?
Well, I think one of the most important lessons is that, while the specific assets and players might change,
Uh-huh.
human behavior remains remarkably consistent.
Okay.
We're always going to be susceptible to the allure of speculation, the temptation to chase quick riches,
Right.
even when we know it's risky.
Yeah, it's like that saying, those who cannot remember the past are condemned to repeat it.
Right.
But it's more like those who cannot remember the past are condemned to repeat it, but with like fancier technology and bigger numbers.
Exactly, but awareness is the first step, right?
Right.
Recognizing these historical patterns, understanding the psychology behind speculation,
Mm-hmm.
it can help us make, more informed decisions.
Mm.
It's about being vigilant, even when everyone around you seems to be getting rich quick.
Right. So what should we be looking out for? Like, what are some red flags that might signal a potential bubble?
Well, Chancellor highlights a few things. Rapid price increases that seem detached from underlying value.
Okay.
Excessive leverage, where people are borrowing heavily to invest.
Right.
And, of course, that pervasive belief that this time it's different,
Right.
that the old rules don't apply anymore.
It's that new era thinking we talked about.
I guess, okay.
Yeah, like somehow the laws of economics have been suspended.
Right. And it's easy to get caught up in that hype, especially when you see, others making a lot of money.
Yeah.
But it's crucial to remember that what goes up must eventually come down.
So how do we avoid getting swept up in the frenzy? Is it even possible to resist that fear of missing out? It's definitely not easy, especially when it feels like everyone's getting rich. But the book offers some practical advice, Stick to a well-defined investment strategy, do your research,
Okay.
and most importantly, don't let your emotions cloud your judgment.
So don't panic and buy into the hype just because everyone else is doing it.
Right.
And then on the flip side, don't get greedy and hold on too long when things are going well.
Exactly. It's about finding that balance between, being cautious and being opportunistic.
Right.
And remember, diversification is key. Don't put all your eggs in one basket,
Right.
especially when it comes to, speculative assets.
Solid advice. So if speculation is this like inherent part of human nature in financial markets,
Yeah.
is there any way to control it? Or are we just doomed to repeat these cycles of boom and bust forever?
That's the big question. Chancellor doesn't offer, like, a simple solution.
Right.
But he does suggest that understanding history is crucial.
Learning from the past can help us identify potential risks,
Mm-hmm.
implement policies to mitigate those risks,
Mm-hmm.
and maybe even find a way to harness the power of speculation for good.
So it's not about eliminating speculation altogether, but about managing it more responsibly.
Right. It's about finding that sweet spot where we can encourage, innovation and risk-taking.
Yeah.
But we also have safeguards in place to prevent those risks from spiraling out of control.
That makes sense. It's like we need the fire to cook the food, but we also need a fire extinguisher just in case things get out of
A
hand.
perfect analogy.
Right.
Well, I think we've covered a lot of ground today. It's been a fascinating journey through the history of financial speculation from ancient Rome to modern-day Japan.
Yeah, it's been a real eye-opener for me. I feel like I've gained a whole new perspective on, how markets work, how human psychology plays a role,
Mm.
and how important it is to learn from the past.
Well, I'm glad to hear that. And I encourage all our listeners to check out Edward Chancellor's Devil Take the Hindmost. It's a brilliant and insightful read that'll give you a deeper understanding of the forces that shape our financial world.
Absolutely. And to our listeners, remember, history may not repeat itself exactly, but it does tend to rhyme.
That's good.
So stay informed, stay vigilant, and don't be afraid to ask questions because in the world of finance, knowledge is truly power.
Well said. And on that note, thanks for joining us on the Deep Dive.
Until next time, keep learning and keep exploring.